One of the points you bring up in that article too is trading maybe dollars or currencies for gold, or making gold more digitally accessible. So what are some of the important points of having that ability to in some ways digitize or having digital access to a hard asset like gold?
Well, so a couple of points. One is that let's go back to bank accounts for a second. Banks have been around for centuries, and in 20 years, smartphone adoption has now just exceeded bank account adoption. So more people in the world have a smartphone than a bank account. And probably in 5 years, that gap will be wider because the rate of smartphone adoption is increasing because of the exponentially decreasing costs of, the devices, especially the inexpensive ones, as well as all the infrastructure that allows them to have, mobile data. And so basically that gives people global access to hold an asset, even a bearer asset, move it around, use the internet to exchange value, get financial services. And I think a basic premise is, why should it be the case that everybody who has a smartphone can access good money, access a global marketplace of monies, and get basic financial services, uncensorable payments, savings, things like that. And so, like, for example, one thing stablecoins do is they say, well, if you're an Argentinian and you want to hold dollars, you don't want to hold dollars in your Argentinian bank because they have a history of confiscating them. You could hold them on, you could hold them on a hardware wallet, and you hold stable coins on a hardware wallet, and you're still reliant on the issuer of that stable coin, but that issuer is not in Argentina, right? You've now accessed a global marketplace of dollars. And for some percentage of your savings, that might be a better risk reward than other things that are available to you. Mm-hmm. There's also been the same thing. We have essentially stable coins with gold, where basically instead of accessing gold physically, which I think is usually the best option, but if for some reason you can't, or you're traveling a lot and you want some gold price exposure, there are redeemable. There's kind of like an ETF, but instead of just trading for a limited period of time on an exchange, you have this globally trading token that represents redeemable claims for custodied gold. And so you've essentially abstracted gold, and now you have you still have counterparty risk, but you can choose what counterparties you want to work with and have that price exposure. And I think the last point there is, in the United States, stocks trade at about 19% of the time. Right. So they only trade a handful of hours each day. They only trade 5 days a week. They don't trade on holidays. And when you add that up all together, throughout the course of a year, their trading hours are 19% of all the hours in the year. So the other 81% of the time, they're not trading normal hours. There's after hour stuff, there's futures, there's things like that, usually not accessible to retail as easily. And essentially what I think a reasonable question to ask is, why can't they trade 24/7 like stablecoins, gold-backed stablecoins do, Bitcoin, things like that? And then also, let's say you're in Nigeria and you want to own Apple stock. That's kind of hard to do sometimes, unless you're wealthy. Mm-hmm. But if you could have any sort of traditional security be accessible to anybody with a smartphone, I think it opens up the types of assets that people can own globally. So I think those are reasonable questions to ask when it comes to, can you improve both the money rails and then the trading rails? And I think the only thing I would differ on is that a lot of people in the broad crypto space focus on those trading rails, those leveraging rails. And while some of that's interesting, I think the most important thing that the world lacks is a good sound money. I think that's where it's worthwhile to focus.
Mm-hmm. Yeah, that's a really interesting idea and a great stat that securities are only available to be traded, like you said, 19% of the time. Lynn, there are so many contradictory forces really looming over the year ahead here. Are there any particular asset classes that provide you with potential growth over the medium to long term here?
So I think medium term is just challenging all around. Because we have various, in this year, 2023, we have a bunch of U.S. recession indicators. That's partially offset by China's reopening, potential emerging market opportunities, dollars, off of its highs. It's unclear if it's going to stay there or not. And so there's a lot of uncertainty in, say, a 6 to 12 month period. Um, I am pretty bullish on precious metals. I'm always tricky with 1 year forecast because you have to be right about the fundamentals, but then you also have to be right about what people are going to pay for those fundamentals. And that's, in 1 year, that's like a guessing game. That's, it goes back to that old quote, like, in the short term, the market's a voting machine. In the long term, it's a weighing machine, right? So over the long term, they reflect fundamentals. In the near term, it's mostly sentiment, liquidity, things like that. And so I think there are plenty of opportunities in emerging markets. If you look in North America, I think that pipelines are still pretty attractive. I'm long-term bullish on energy. Unclear for this year because of some of those recession indicators, but long-term bullish on energy, precious metals. I'm less bearish on banks than a lot of people are. And then of course, I do like a Bitcoin allocation and just select equities in different sectors that I think are recession resistant or that, might face turbulence in the recession, but that are well positioned to get through it and then provide good 3 to 5 year returns from there.
Mm-hmm. I'd like to dig into some of those things that you mentioned, but before that, you mentioned that we're really this U.S. economic cycle is really pointing towards a recession later this year. So let's dig into a little bit of the inflationary aspect that we're seeing right now. Despite easing CPI prints pointing towards a disinflationary growth period, are we in a larger period of structural inflation?
That's how I view it. And if you look at the 1970s and 1940s, which were the prior big inflationary cycles, they also had periods of inflation, periods of disinflation, even though the decade as a whole was quite inflationary. Mm-hmm. And so right now, I think we are in a cyclical disinflation within a broader inflationary period. I think that, this inflationary period is not going to end until there's a big energy capex cycle. So you get a lot more cheap energy supply, because as long as we're still supply constrained, and any sort of big growth spurt we get is probably going to come with inflation associated with it, just because the supply side is still tight. Mm-hmm. In addition, when you look at the really long-term macro, when you start to get countries, a lot of them well over 100% debt to GDP, and those debts are denominated in a currency that they can print, the normal historical pattern is that you inflate the debt away, that you run inflation hot while holding yields relatively low. And, that basically you have to go back to the 40s to find a similar economic environment that we are now, as far as, say, Western, developed country sovereign debt is concerned. And so that should be a pretty inflationary trend as well. So both looking at the commodity capex cycle and the macro sovereign debt long-term cycle, I think both of those point towards structural inflation, say between now and the 2030s. But there are periods of time where central banks and governments fight back. In the 1970s, 1940s, you either have the central bank fighting back for periods of time, or you have things like price and wage controls trying to fight back. There's all these ways that they can hold the volleyball underwater for a period of time until something happens and they let it go, and there's another round of inflation.